A great crowd. Man, it's hard to believe it's 2026. The older I get, the quicker it goes. Anyway, good morning. My name is Marshall Mills, and I want to welcome you to our 2026 annual forecast. We're so glad you're here this morning. I first would like to thank our customers, many of whom are here today, for allowing us to handle your real estate needs over the past several years, and we appreciate the business. I also would like to thank our leadership team and all of our associates for all of their hard work this past year. We have a great lineup for you this morning. Bob Young, our Executive Managing Director, will deliver the results for our 2025 survey. This year, we used AI to help assemble the data for the results of this survey. This represents the evolution of our market insight over the decades, and the vision and legacy of our research continues after being established in the 1970s by our founder, Herb Weitzman. I don't think any other firm has our track record of market intelligence spanning the decades. Our time reviewing the market, compiling the information we study and utilize on behalf of our clients is what keeps Weitzman on the cutting edge of information. We never forget that information and data that are critical to our growth. Weitzman's investment in programs like this one today is what sets us apart. Our information has influenced industry experts in Texas as well as nationwide, which has been a key part of our reputation as a legacy firm with a deep commitment to Texas and our industry. Now back to today's program. Our Executive Chairman, Herb Weitzman, will have a conversation with Rob Kaplan, Vice Chairman of Goldman Sachs and former President and CEO of the Federal Reserve Bank of Dallas. There's no one better than Rob to offer insight into what lies ahead. He's one of the most recognized leaders in global finance in the U.S. Federal Reserve policy. Now it's my pleasure to introduce Bob Young, who will deliver the results for 2025.
Thanks, Marshall, and good morning to everyone. And I echo Marshall's comment. We have friends near and far here, and we're honored of your presence this morning. Weitzman has presented this forecast event for decades now, as many of you know. But this is the first time ever I can use one of my favorite sports terms, one coined by legendary NBA coach Pat Riley. In DFW, we have a retail three-peat. There you go, thank you. For the first time in our 36-year survey, 3 years in a row, occupancy has been at record levels. Right now, we're celebrating the market's highest ever number at 95.3%. That's following back-to-back records set in 2023 and 2024 when that number was 95.1%. And this back-to-back performance cements the remarkable retail stability in the face of inflation, tariff uncertainty, chain failures, rising construction costs, capital markets ups and downs, and other economic headwinds. Clearly, brick and mortar has proven its strength as the preferred shopping option. I just returned, along with many of my colleagues, from the New York ICSC, where Walmart's J.P. Suarez spoke. Many of you will remember J.P. when he was one of our previous speakers here at the Bush. J.P. said Walmart, and this is no surprise, the world's biggest retailer, views the physical store as a critical component for retail success. Physical stores account for nearly 85% of Walmart's overall sales. Here in DFW, physical retail rules as well, especially in terms of grocers, entertainment, fitness, health and wellness, beauty, medical and dental, dining, and other options. JP says shoppers change retail channels based on their needs. The customer is going to be loyal if you give them the choice to shop multiple ways. That's why retailers and shoppers benefit from the convergence of digital and physical. We at Weitzman call this tech and mortar. And digital, working with AI, as Marshall mentioned, offers the ability to satisfy needs through personalized approach based on consumers' searches and preferences. Now to our survey results. At the end of 2025, inventory in DFW totaled 202 million square feet. This inventory reflects new deliveries during the year, as well as approximately 990,000 square feet removed from that data set due to projects being demolished or remodeled. Most importantly, our survey now provides information on 52 submarkets compared to 42 submarkets in 2024. The new submarkets reflect changes in DFW's rapidly growing marketplace. For example, some of our submarkets had gotten so large that they practically required a hotel stay to drive from one side to the other. These are areas like Arlington and Plano, as well as Northeast Tarrant County. Therefore, we divided the huge inventories into multiple submarkets according to geography. Further, these changes reflect DFW's population growth in almost every direction, 360 degrees. New submarkets like Salina were added to the north and Forney Terrell added to the east. So let's quickly cover the procedures for our survey. We maintain a database of 1,440 shopping centers in DFW with 25,000 square feet and more, not 24,999 and below. Our Weitzman team then travels to every one, and we go to these centers to record changes in occupancy, tenancy, and size. This at-the-property research takes a lot of time, as you could imagine, but it offers insights that go far beyond researching a site plan online. These drives show us firsthand what works and what doesn't in terms of location, layout, and tenant mix. That's the insight we use to our clients' benefits every single day of the year. With that in mind, let's look at three key factors that keep our market strong. First, retail construction remains conservative. We are in the midst of a decade-long period of good news in our space. New deliveries still remain in check. Second, we did see construction jump in the past couple of years, but importantly, new space is dominated by anchors. In other words, new space means new occupancy. And third, as J.P. Suarez said so well, brick and mortar retail remains essential to retail and to retail real estate. Even for online shopping, the physical store acts as a brand ambassador for online searches. It builds shoppers' trust to patronize a brand that they see in the real world in real time. Now let's look at some points to consider regarding our record-setting occupancy. It reveals vacant space of 9.5 million square feet out of this very large market of 202 million square feet. That's a decline from 9.7 million square feet in 2024 and a huge drop from 17 million square just 5 years ago. Let's now take a quick look into our retail numbers. Occupancy in the Dallas area was 95.2%. That's from 1,014 projects totaling 138.5 million square feet. The occupancy in the Fort Worth area was 95.3%, based on 427 retail projects totaling 62.3 million square feet. As you know, Weitzman also reviews our other major markets in Texas: Austin, Houston, San Antonio. All of these markets are posting record or near record occupancy above 95%. Without a doubt, kind of self-serving but with great pride, Texas retail is firing on all cylinders. Let's now break down the positive impact of strong net leasing by major shopping center surveys in our categories. Grocery-anchored community retail led the pack in 2025. During the past year, community center occupancy reached 96.4%. That's the best result ever. That's a major reason why our entire market is so healthy. Plus, our largest category, grocery-anchored community, is also our strongest. Grocery-anchored retail dominates the market inventory in 498 centers totaling 76.2 million square feet. Further, community was also the most active construction category with more than 1.9 million square feet of grocery-anchored space. If you were with us last year, you will recall that we termed 2024 as the year of the grocer. That certainly was accurate. But now we need to add a big ol' S to the word year, because we're definitely now experiencing the years of the grocer in 2024, in 2025, and to come in 2026. In 2025, and this is very important, traditional, specialty, and superstore grocers accounted for 82% of all new retail space. And based on the pipeline, we will have our third year of the grocer in 2026. Remember, retail follows rooftops. And today's grocers are expanding due to our market's phenomenal population growth. Part of that activity is related to grocers actually catching up with that growth. In the early years of this decade, think about this, there were not many new grocery-anchored centers done. In the 5 years between 2019 and 2023, DFW added only 13 new grocery projects. And one of those years, 2021, astonishingly, there was no new grocery anchors presented. But population continued to grow from 7.5 million in 19 to 8.3 million and growing today. Then came our first year of the grocer, 2024, when 7 new grocery projects opened. Then comes 2025, when 18 new grocery stores opened this past year. And currently, and almost unbelievably, we show 34 grocers in the works in 2026 and into 2027. From our lens, DFW is definitely the most active grocery market in the entire country. Now let's look at neighborhood centers. Neighborhood centers are the market's smaller, unanchored projects. Neighborhood with an inventory of 40.2 million square feet saw overall occupancy remain healthy at 91.7%. This category succeeds through visibility and, most importantly, convenience. If you think of where you get your dry cleaning, where you get your coffee, your pizza, your haircut, your dental work, chances are they're in a neighborhood center. And today's new generation of neighborhood centers offer more patios. They offer more drive-throughs, more green space, and more reasons to visit again and again. Let's move categories. Now, malls. Malls have recovered from so many department store closures over the past decade or so. Today's malls are often entertainment-focused with a mix of large format uses like family centers, arcades, bowling, and dine-in cinemas. As a result, this category is now stable with occupancy of 93.3%. Our market has seen more than a dozen demolished malls or redeveloped malls, with the remaining malls being the strongest for the most part. And while a handful of weak malls still remain, these are most likely candidates for redevelopment in the growing DFW marketplace. Most importantly, malls reported positive absorption of 440,000 square feet, with new tenancy that ranged from apparel to entertainment to experiential. Now let's talk about mixed use as a category, with an inventory of 11.2 million square feet of retail space. The category reported strong occupancy at 95.3%. The best used mixed retail is located in projects with high density multifamily, followed by office, hotel, public sector drivers, and other complementary uses. This category continues to grow with new concepts like Lombardi's Parker Social at West Plano Village, and new projects like Fields West and the Mix in Frisco, and Weitzman's Castle Hills retail and residential mixed-use project in Louisville. Now let's move to power centers. Power retail with an inventory of 44.7 million square feet reported occupancy of 96.3%. This category, as you know, has borne the brunt of chain failures over the past year, from Bed Bath & Beyond to Conn's to Joann to Big Lots to Party City. Notwithstanding, it never ceases to amaze me, but in our market, when one store closes, another one opens. Leases from expanding fitness, home furnishings, discounters, and entertainment concepts are big reasons why these dark spaces keep finding new tenancy. Now let's address net leasing. Absorption, also known as net leasing, is the net change in occupancy during our survey period. Absorption in 2025 totaled 2.5 million square feet, a healthy total on par with 2024's number of 2.4 million square feet. And we do expect another great year for leasing in 2026. During 2025, great concepts drove DFW's net leasing success. This is a great list to listen to. Concepts like Trader Joe's, Sprouts, PetSmart, EOS Fitness, Planet Fitness, Junior Department Store Belk Market, Rockham Western Wear from Houston, Cavender's, Burlington, Ulta, Barnes & Noble, and Joe V's from H-E-B, they all expanded into existing retail. Now let's turn our attention to construction and talk about it in more detail. New space deliveries during 2025 surged to 2.4 million square feet. That's up from 1.5 million square feet last year. Grocers, as you would imagine, were the big construction drivers in 2025. As previously noted, more than 82% of all new space last year was built for, again, traditional, specialty, and superstore grocers like Kroger, H-E-B, Tom Thumb, Sprouts, and Target. That's more than 1.9 million square feet. And about 17%, 408,000 square feet, was built for home improvement and other non-grocery anchors. As we look forward to 2026, We will see new stores from the following: Kroger, H-E-B, Tom Thumb, Walmart, Costco, Sprouts, Target, H-Mart, Home Depot, Lowe's, IKEA, and newcomer BJ's Wholesale Club. This incredible lineup of retailers are making a strong retail market even stronger. So in closing, I'm tempted to end on a very high note, three-peat, y'all. Thank you. But remember that Weitzman, we are a student of the market. And we know that each year promises new challenges that you could only imagine. Now, today's DFW retail market has never been stronger in terms of balanced supply and demand. And that's also why Weitzman in 2026 is leasing 10 million square feet of new space being built in the great state of Texas. Now, we've gone from heated markets, overheated markets, frankly, in the 80s and the 90s, to recession-ravaged markets in the 2000s, to COVID in 2020, to end up where we are today, which is a retail market that is firmly rooted in the fundamentals: population growth, housing growth, and economic viability. But we also need to proceed with the understanding that our market will present challenges and setbacks. Right now, for example, we are looking at some economic softness in terms of the job market, as well as continued costs to inflation and tariffs and the uncertainty around those factors. So the runway looks clear, but watch out for the potholes. That's why we are so fortunate today to have as our guest Rob Kaplan. No one understands the economy better. That said, our forecast for 2026. First, occupancy. We expect the market to remain stable, very important, and end the year at 95.4% leased. Second, absorption. We forecast net leasing of more than 3 million square feet in 2026. And finally, third, construction. Based on everything in the pipeline today, we could see construction around 3.8 million square feet. And by the way, that total would be the highest level of deliveries since 2018, when the market added 3.5 million square feet. So on behalf of everyone at Weitzman, thank you very much. And please make special note that this entire Texas retail report is now available on our website. We are truly in a great market. And even when we face challenges, we face them together. We use the term co-opetition for the way that our industry and our cities work together for the region's good. Thank you very much. Now it's my honor to introduce Rob Kaplan. Rob is the Vice Chairman, Partner of Goldman Sachs, and the former President, as Marshall said, of the Federal Reserve Bank of Dallas. Rob will provide us with real-time insight into our economy and the outlook for 2026 in a one-on-one conversation with our founder and Executive Chairman, Herb Weitzman. Please join me in welcoming Rob and Herb. Gentlemen.
Well, Happy New Year, everybody. Starting out with the buzz this morning, and I think that, we are so lucky to be in Texas, and we have a wonderful development and retail community in DFW, and we all work together, and we're so fortunate to have Rob Kaplan with us today. A little bit about Rob. Rob's an educator. He taught at Harvard. He became Vice Chairman of Goldman Sachs, and then he's also as Bob said, President of the Federal Reserve Bank for this district, and I don't think there's a smarter guy on the planet, that understands everything that we are going through right now. I think every week, started out on Monday, Rob, and I said, what could happen next? And you know what? Sure enough, it happens. So, I think that we're here today to learn from you, and we've got a bunch of questions. But Rob was with us, I think, 8 years ago, a little over 8 years.
Yeah.
And start off, what's different? What are you thinking about, where we're going and what changes?
And it's great to be here with you,
Thank you.
Herb, and everybody here. So when we were talking probably 8 years ago, I think we were talking about the story of Texas is a story of migration of people and firms to the state. That actually hasn't changed. If anything, that's continuing, and it affects Dallas, but it affects the entire state. The big thing that's happened in the last 8 years, which is a game changer, is we went through COVID. But what came with COVID, as you and I have talked, is we leveraged up as a country. We went from probably the day we were talking 8 years ago, we were maybe mid-70s net debt to GDP in the United States. Today, we're over 100%. What happened? Partly in response to COVID and partly in the aftermath, $2 trillion for the CARES Act in 2020, $2 trillion American Rescue Act passed in 21, spent over 4 years, Inflation Reduction Act, Infrastructure and Chips Act. And so we outgrew the world in the last 4 or 5 years in terms of GDP because of excess fiscal and also excess labor force growth due to lax immigration. But the hangover that we're dealing with today is we're a lot more highly leveraged at a government level, run bigger deficits, we have higher interest expense, and that's a little bit of an overhang. The other big change from 18 is this whole AI data center power boom. I don't know if we could have envisioned that in 18, but that is an enormous tailwind, I would argue. First for infrastructure building, but over the many years, probably for better productivity growth or the opportunity for better productivity growth. So those are some of the changes. With all that, we were starting a mini trade war when we last talked 8 or 9 years ago. In 18 and 19, we have a much more widespread, there are reasons for it, trade disputes, deglobalization, and as Bob mentioned, businesses and particularly retailers and others are wrestling with that. But we've got some tailwinds that are really going to overwhelm some of these headwinds. We can talk about both.
Mm-hmm. Well, our business runs on capital, and we're fortunate, to have a lot of capital in the markets today. But we've faced a lot of tough issues since 08. Since 8 years ago, and talk about the changes in bank regulations. What about there's been a big movement of mergers. There's been also many regional banks that are worried. We went through what happened in California with First Republic. And
so there have been 3 or 4, I would call them headwinds. Tariffs started in 25, that's a headwind. We can talk more about that. We have had very healthy labor force growth in the United States and population growth up to the start of 2025. That's changed. Mm-hmm. We've got much slower, and we're going to have much slower labor force growth and lots of open jobs we can't find workers to fill, and lack of immigration, and we're an aging society. Unfortunately, to your point, what happened leading up, and this is in 2023, you had very lax monetary policy that probably went on for too long. We had lots of bond buying at the Fed, you had a jump in bank deposits. The money had to go. There was a lot of money being injected, particularly the Fed balance sheet went from $4 trillion pre-COVID as high as $9 trillion. That money had to go somewhere. A lot of it went to bank deposits. And Silicon Valley Bank and First Republic that you're referring to were examples of where deposits jumped. And unfortunately, some of these banks made the decision to buy long-term bonds. And the regulators should have been all over that to have stopped it and preempted it and encouraged these banks not to do it. But for whatever reason, they didn't. So it's called asset liability mismatch. So what happened, you're referring to in the spring of 23, is people realized, oh my God, some of these banks have all these unrecognized losses. And that includes not just Silicon Valley, First Republic, Signature. B of A had substantial. Schwab had substantial unrealized losses, and people started to realize maybe bank deposits weren't as secure as they thought. And so this caused enormous upheaval in the banking sector. Unfortunately, the response from the government was more regulation. It wasn't to prioritize, the biggies, loan to deposit ratio, credit issues, uninsured deposits. It had a raft of widespread more regulation to where most banks who are in this audience, small banks and big banks, had to staff up dramatically to deal with this new regulation. And it impeded, I would argue, it trapped capital. And this is why this year we think the banking industry is going to have $200 billion more capital just by a stroke of a pen. Some of these supplementary leverage ratio, some ideally easing sensible bank regulation is going to free up a lot of capital. But it put constraints on bank capital, and what it led to is the growth away from banks in private credit, because banks were so highly regulated, there was still a lot of money out there. It went into unregulated lending, and private credit boomed. I think that's a good thing. Maybe it's gone overboard in spots. As we head into 26, though, just to square this, you're going to have banks being, I hope, in better shape, a lot more capital. I hope there's going to be regulatory relief, including for the small banks, but we're waiting for it. So you're going to have banks being able to do more. And you still got this very big private credit industry that also will be available. So I think you're going to have good availability of credit now, but we went through some, few years there where it was really tough to be a banker.
Well, there were some changes that took place, and with regional banks or smaller banks, they lost a lot of deposits to the big banks. And those of us here, who are small borrowers, small projects, we talked to somebody yesterday, and found out one of the big banks, that they, in $3 billion of lending, they, I think, had placed that money with maybe 15 borrowers.
Right, that's right.
Yeah, it was huge.
They don't do small
loans
bank.
were off the charts. They were so huge. We don't play in that game.
That's right.
So the banks have asked for deposits for loans. Not that it's secured, the money's secured, but if you're not putting money in a bank, you're not going to be borrowing much money from them.
Right.
Now, is that going to change, or based on what you just said about more money flowing into the banks, or do you think, even though that's not a law, but all the banks have followed suit, pretty much?
Okay, so let's put this in context. There's 4,150 banks in the United States. 80 of them have assets over $20 billion. Okay? So the point is, most of those 4,150 are small. And we've got 500 or 600 of them, let's say, in the state of Texas. Most of them are relatively small. And yes, I'd say that ironically, for all the talk about too big to fail after the great financial crisis, the big banks have an enormous advantage over small banks in attracting deposits, and big banks don't tend to make small business loans. We need small banks to get deposits, and we need them to make loans. So is that going to change? No, I actually don't think that's going to change much. I would guess you're going to see more bank consolidation, more mergers. I think it'd be a healthy thing. The regulators, I would urge them to allow it. That 4,150 needs to be some, 1,000 less. But I do think for small banks, I'm hoping that the regulators will do some tailoring, ease regulation. Again, hadn't happened yet. But yes, I think if you want to borrow from a bank in the future, yes, it's going to be important that you also make a deposit. And, I think as a local business person, I think, fine, we'll support our local bank. But the big banks, you notice JP Morgan is making a big push for deposits. Wells Fargo just had their cap raised. It's a very competitive world out there. And so it actually makes a lot of sense. I would actually love to see the government raise the FDIC insurance level and put smaller banks on a more level playing field, but assuming that doesn't happen, no, I think you're going to see small banks continue to want to see deposits.
Thanks. By the way, when we finish the program with Rob, we're going to open the floor to questions. So, if there's something that you think about that everybody will benefit from, just don't hesitate when we open the floor up to questions. Just wanted to make you aware that we're going to have a little time for that. Let's talk about tariffs. They seem to be winding down. And give us all the details about the tariff story, because there was cancellations and changes, and it doesn't seem like too many people now are being affected by it.
No, well, that's not the case. And I deal with, I cover companies 80% of the time, or I cover clients, and no, they're widely affected by it. But companies are very resilient, and they're adaptive, and they're adapting to it. And they also don't want to talk about it publicly. Not smart to talk about it publicly. So what I'm seeing is, here's the big surprise that happened in 2025. We had thought, when there was a lot after the election, that there would be tariffs, but they would be more strategic. What do I mean by strategic? We'd try to bring back high value-added manufacturing in the United States. We don't want to do sneakers and T-shirts in the United States. What goes with Made in America? Made in America, the key element of Made in America is logistics and supply chain arrangements with Canada and Mexico. North America and that integrated relationship where goods go back and forth across the border, cheap natural resources from Canada, cheap labor from Mexico, has been central to companies deciding to domicile here and being able to be globally competitive. The other thing that happened is when we had a trade dispute in 18 and 19, say with China, companies had other options for alternative sourcing. So it didn't turn out that way. We have not reaffirmed the relationship with Canada and Mexico. And we also have got the tariff disputes have been almost every country in the world with some exceptions. Why did this happen? I think the main reason was back to government debt to GDP. This administration came into office with a $2 trillion estimated deficit, interest over $1 trillion, debt to GDP, total debt, they had to sell $38 trillion on its way to 40, and we're struggling to sell long-term treasuries. And what I think they decided they wanted to do is use tariffs as a source of revenue. It's not that we still don't want to strategically reshore, but we put tariffs on a lot of products that we're not going to really want to make in the United States. A lot of what Vietnam produces, for example, we don't really want to make here. We really don't. Reshoring aluminum and lumber in the United States, we could do it, but we're having enough problems producing power just to do the data center boom. And so a lot of the reason this happened is we wanted the $300 to $350 billion of revenue that came from increased tariffs. And we have really never historically used tariffs as a revenue generator. We used it to try to improve competitiveness, reshore things that are strategic. So businesses, as they often do, it was abrupt, They struggled. The initial rates on Liberation Day were very high. They've come down. But businesses are adapting, I can tell you that. Every one of them, they're adapting. And big businesses are taking some out of margin. They're negotiating with suppliers. They're going to try to get some price increases in. The part that we're seeing, and we were talking about this, it relates to retail. Small businesses are struggling still with these tariffs. They're not complaining publicly about it, but you're going to see more small businesses go out of business this year. And you may notice in the weakness in the labor market, it's disproportionately centered on small business, the job losses. That's not an accident. So the tariffs, the reason you're not hearing more about it, it's not they haven't gone away. They're still in the, in the mid-teens. It's just businesses they do are adjusting to it. And there are other significant tailwinds that are also helping. You've got tax incentives coming, substantial tax incentives coming in 2026. You're going to get a big tax refund. You're going to see consumers are going to get a big tax refund in the first quarter this year because many of them were over withheld last year. They're going to get a refund. You're going to have accelerated depreciation kick in 26. It's going to spur growth. You're going to have regulatory relief. I talked about it. You'll start to see manifestation of it with banks and other industries. And then you've got a continuation of the AI data center power boom. So yes, tariffs is putting sand in the gears, but you got other tailwinds that are helping businesses, and it helps explain why we think GDP growth in 2026 is going to be, in excess of 2.5%. It's going to be higher this year than last year because these tailwinds, particularly tax incentives, are kicking in.
Well, that's good news to everybody.
It is good news, and 26, 27 are going to be good business years. The thing you're going to still see the remnants of, depending on what business you're in, you'll see still stickiness from tariffs, and you can see one other thing, lack of labor force growth. You're going to be hearing this quietly all through the year. Yes, AI will replace jobs. College graduates have a hard time finding jobs. The issue is, that's a structural issue. Lots of people looking, lots of open jobs. I mean, the CEO of Ford Motor Company keeps talking about the fact we cannot find workers to make $125,000 years to work on the line. In construction, in agriculture, in services, businesses are struggling to find jobs. It's just those people looking don't want yet those jobs. We've got a mismatch issue, and we're still dealing with that. But the other thing you're seeing is the lax immigration is over, and there might be as many as 12 to 15 million workers in this country that make up a big chunk of agriculture, services, construction that are unsure whether their immigration status is going to allow them to stay. And we're hearing from businesses every day, some percentage of these people are not showing up at work, not sending their kids to school, definitely not out shopping at the mall. And I think clarifying their status, on the one hand, would help stabilize the workforce and would improve growth. But assuming that doesn't happen, you're going to see still a lot of quiet talk this year. You may have sluggish hiring, but you're not going to see unemployment go like this, I don't think, because of lack of supply. That's why unemployment has not ratcheted up more.
Yeah. Well, I want to focus just a minute on construction because a lot of us deal, with negotiations and TI, tenant allowances and everything. And what I wonder about is, I've talked to a major retailer yesterday, and their cost from 5 years ago has gone up tremendously. Now, how are we going to continue to be affected, with tariffs as it relates to construction?
It's raising. I hear this everywhere I go. The cost to produce is going up. One, tariffs have put sand in the gears of costs. The fact we don't have the same relationship with Canada and Mexico has affected costs. The steel tariffs have saved, in the scheme of things, a relatively small number of jobs, but the user number of user companies affected by those tariffs is substantial and is affecting multiples of that in terms of jobs. So the costs are higher. And also the fact that you're struggling to fill some of these open jobs. And AI, if you're a construction person, AI is not going to help reduce your materials cost and your construction costs and your costs of labor. So I think it's becoming, unfortunately, a little bit of a fact of life that most businesses I know are just trying to figure out how to maneuver around it. But for construction, what I would love to tell you, oh, it's going to get better, but I don't know that it's going to get better. And then the other hope has been, well, rates will come down. And you remember the short end of the Treasury curve, rates have come down. They've come down 175 basis points since September of 2024. What's the 10-year done since September 2024? Nothing. It was 425 in September of 2024 when the Fed started cutting. Where is it today? I don't know, 416, 417. The curve's getting steeper. So maybe some relief at the short end of the curve will help construction loans. The issue is the back end is still sticky. And for those folks who want to term out, who are hoping for relief, we're not seeing that relief yet.
Yeah, well, the multifamily market, in the construction is tailed off, and numbers didn't work.
Right.
So there was a tremendous slowdown in lending with all the major banks, and it's starting to come back.
Yes.
There's occupancy, there's demand, but even though we see, concessions made for new renters, in the retail sector, Bob in his presentation said, 82% is the grocers. They've got tons of money.
Yes.
So, that 18% is the rest of us that are building shadow anchor with them, are building, smaller centers.
Right.
I think the days of the power center and the big center, of course, what's going on with malls. Bobby Taubman's one of your best friends, and he's out of the business, and
Right.
you've seen how that's changed so much. Well, I think that my question is that with what's the future look like? Is it going to turn around again? Because, in your opinion, what does the government have to do that might affect us on the real estate side?
Okay. So far we've talked about the cost side. Listen, if by some chance over the next few years we restored our relationship with Canada, we stopped talking about reshoring aluminum, lumber. I think that, I don't know that that's going to happen, but that would be helpful. But let's assume we don't get a lot of relief on the cost side. The one thing that's really been helpful is on the consumer side. There are two big groups of consumers. You and I have talked about this over the years. There are 85 million workers, let's say, in the United States that make 50 or 55 grand a year. They're employed. By the way, they're not unemployed, they're employed. The problem they're having is they've lost 25% plus purchasing power and they can't make ends meet, but they're spending every dollar that they make. Problem is if insurance premiums go up or healthcare, they just have to choose something else they're not going to spend on. These tax refunds that I talked about into 2026, tax on tips, tax on overtime, they'll have more money in their pockets, and every indication, they're going to spend it. The issue is they don't have financial assets, and they don't have that cushion. There's another, let's call it 85 million consumers who own their home, have financial assets, and this period in the last 3 or 4 has been terrific in that any inflation they've suffered has been more than offset by appreciation either of their home, they usually have low rate mortgages, or appreciation of financial assets, and they are spending. And so when I talk to retailers around the country, and you and I have compared notes on this, both groups are spending. This group is watching every dollar and is making tough trade-off decisions. This group still has plenty of money to spend. I think financial markets, equity markets are going to continue to be pretty good. We think they're going to be in the next couple of years. And so on the demand side, the retail demand we think is going to be pretty solid or strong. And again, higher GDP growth, if we really grow in 2026, 2.5%, and we've got this construction, CapEx boom, we've got these tax incentives, we've got regulatory relief, we've got banks having more capital. I mean, yes, costs will be higher, but there'll also be demand and that we can use to manage it.
Well, I'll kind of close here, but we collect rents on 4,000 tenants in the 5 big cities, and we have offices there, so we keep up with their delinquencies and so forth, and we're not experiencing much in Texas. So I don't know if, because of all of the capital that's come in to Texas and then is going to come into Texas, in the future, I'm looking at the fact that we've got the wind at our backs, so to speak, with all this in migration who are buying, and we don't see many delinquencies. So I look at that as a real positive for Texas.
It's a real positive. Listen, if you look at a heat map of the United States, one of the big problems in the United States is aging population. I wish we weren't, but aging. Workforce growth before immigration is down to 0.25%. However, there are 4 or 5 states, Texas is one that's bucking that trend because of, you said, migration of people and firms to the state. And listen, anybody I talk to in the United States, and I talk to a lot, who's not here now, and even around the world, they want to think about coming here and bringing their employees here. And so I think we've got the wind at our backs in Texas for an extended period of time. We'd do better if the country did better. But in terms of demographics and population growth, we take it for granted here a little bit. We were 12, 13 years ago, I think 22-ish million in the state of Texas. We're at 30. We think we're on our way to 40. That's extremely unusual in the context of the United States, and we're benefiting from it. Now, the other thing I'd say about delinquencies, it's hard we haven't had a credit cycle in a long time in the United States. And people are worried, well, maybe we're going to have a credit cycle now or delinquencies. Hard to have a credit cycle if GDP doesn't go down, okay? You need a fall off in business. We will have a credit cycle someday, but I'd be surprised if we have a severe one or one at all in 26 or 27.
Well, some of the biggest questions that I've heard, in capital market leadership is the possibility, geopolitical issues.
Yep.
And I don't want to, you can talk about that if you want to.
No, I can.
That's a bigger.
We talk about it every day.
That's a bigger issue, and also we're going to get into immigration. But let's right now. Let me ask you about, your thoughts about, Dallas fast becoming, a very interesting financial hub, with New York Stock Exchange coming here, with NASDAQ coming here, and the Texas Stock Exchange.
I would say, this is my own view, and I work at a firm, Goldman Sachs, where we're on our way to 6,000 people here. We already have 5,000. We're building a new building. We're active throughout the state. I would say the driver in the state of Texas is, again, migration of people and firms to the state, enormous fundamental business drivers. The financial industry growth, honestly, is more coincident with it than a driver of it, if that makes sense. It's a great thing, but the truth is, when we domicile close to 6,000 people in Dallas, say at Goldman Sachs, it's to serve our clients in the United States and the world. I spent half my time, somewhere else in the country. I got back from another country last night, as you and I have talked. The point of it is, people are deciding this is a great place if you're going to be a global firm. What's the magic of New York? Why not Dallas? Why not Texas? And so we're seeing more and more do that. I think when people see us do it, other firms will say, well, why don't we do that? Maybe we should do that. Better access to talent, more diversified access to talent. You'll see that trend continue, and that'll be helpful.
Well, I think, more banks are coming here. There's more mergers
Yes,
that have
they're,
been out
well, they're buying, they're
just
they're-
recently.
Yeah, because listen, if you look at the U.S., we're going to have good growth this year and next year, but ultimately, what drives GDP growth? Growth in the workforce plus growth in productivity. There's a third way you can drive growth: leverage up. We've already exhausted that in the United States. And so when businesses and some of the, like Huntington and other banks in the United States are Fifth Third and saying, where do we want to be? Where's their growth? Well, it starts with where's their population growth, not a long list. And so you're going to see people want to try to look to be here.
Well, can you quantify, what the impact of those stock exchanges coming to town? I've heard several speakers talk about it who were involved directly for the audience.
So obviously, and we're in, as you know, we
If you're just going to
disclosed,
put more of a highlight on Texas.
I would say the following. Listen, New York Stock Exchange is realizing they need a presence here. The Texas Stock Exchange, we just became an investor, as we announced in it. Is that by itself going to drive more growth? I think it's an enhancement that's positive. What I flag it as, therefore, we're going to grow faster. I still think the fundamentals, migration of people and firms to the state, pro-business environment, central location, low taxes, enormous energy industry, and then you want to see, do we have good access to workforce? Are there good schools? Is there good higher? Those are still the fundamental drivers.
Mm-hmm. Okay, well, you talked about the K-shaped economy.
Yes.
And do you see that, moving ahead with the wind at our back right now? There's let's talk about maybe deregulation.
So
that makes it easier for people to do business.
So let's talk about the K a little bit. So when we say K, I talked about the 85 million who have assets and are spending, and the 85 million who are spending but make 50, 55 grand a year. I would actually argue in the business world, okay, among companies, you will see a record level of merger activity in 2026. Mm-hmm. And we can tell from our backlog and the activity we're seeing. And the one comment I would make is AI, technology-enabled disruption have pushed many companies to feel they're not big enough, okay? So you can either be small and nimble and grow, and you can get to here. You can be gigantic, the Amazons of the world, and a hyperscaler in many industries have the very, gigantic firms that have enormous competitive advantages. In between, early in my career, used to be here. In between has become here. There's a lot of clients that I've worked on for decades that I used to think of huge and dominant, and now with the need for all this technology investment and AI and the risk of disruption and new entrants, Amazon gets into your business, we don't feel so huge anymore. And so you're seeing, and you will see, a need for more size and scale, and you're going to see more merger activity. And this is corporate to corporate merger activity, get more size and scale. It's not that small business won't be able to compete. Mm-hmm. They will, but you've got to have a distinctive competence that's clear. And even as small businesses get bigger, in order to maintain that competence and with the need for more and more technology investing and AI disrupting functions that we would never have imagined before, I think you're going to see businesses struggle with that, and I see that and have conversations about that every day.
Okay, well,
that includes banks, by the way.
Sure.
That's going to cause a lot of bank consolidation too.
Well, the banks are, they're pouring huge amounts of money into AI.
So let me comment, because you ask it, and it's a little bit the elephant in the room, about the geopolitical part. So the story I just told about the United States, what I just told: tariffs, lack of labor force growth, that's a headwind. Tax incentives, AI data center power boom, regulatory relief, that's a tailwind. I think the tailwinds are going to prevail. The one comment I would make, I mentioned earlier, we're highly leveraged in the United States. I spent a lot of time around the world with institutions around the world, and the one comment I would make is institutions around the world tend to be, and started the 2025, over-allocated in their investing to the U.S. in institutions here and globally. I was with a big institution yesterday in another country, over-allocated the U.S., want to stay over-allocated the U.S. What's happened in 2025 is with some of the events that have occurred, whether it's, you can go through the list, that are more unusual based on, the institutional framework in the U.S., I think is giving some investors around the world pause. Doesn't mean they don't want to stay over-invested in the U.S., but they're hedging the dollar, some of them for the first time in 15 years. That's why the dollar weakened some in the first half of last year. And they are on the margin saying, if we have an extra dollar to invest, maybe we want to, on the margin, look more broadly, take a fresh look at Europe. Germany's doing more CapEx. Let's take a fresh look at Asia. Let's take a fresh look at the world. And in particular, the big way you can tell some of this is going on, the 10-year Treasury before this year tended to be the risk mitigant in people's portfolios. I mean, stocks go down, but treasuries will rally, okay? 10-year Treasury is not acting this year like a risk mitigant in the same way. Israel bombs Iraq on a Friday, stocks sell off, check, gold rallies, check, 10-year Treasury should rally, right? Flight to quality doesn't, backs up. And so investors around the world, there's a reason why gold is up 50% plus over the last 12 months and continues to inch up. People are looking for other alternatives as sort of a risk mitigator. It's not that we won't get great capital flows here and opportunities for great investment here, and we've got great companies and great opportunities, and it's a great market. It's just people are looking for a little bit more of their perception of some investors is that tail risk in the U.S. is a little higher. It will not affect, I would guess, your day-to-day activities, but we're out of the corner of your eye, watch gold and watch what's going on with the 10-year Treasury, and I think I will be encouraged if we see more flows in the long end of the Treasury curve over the next few years. But right now, people are a little bit more hesitant. If anything, they're shortening their Treasury maturities. And so this is affecting the mortgage market and mortgage rates, and people want to term out. And so it's a tension that is out there. And so I'll just flag it.
Well, I'd like to move us, based on that, into issues that concern us all, and that's stability. We thrive on stability as compared to uncertainty.
Right.
And I think that, we're playing a long-term game in the short-term cycles, and it worries us. And so do you think that, how does inflation, play a role in this? Because that's one of the big issues.
Yes.
And any other issue that you think that has an effect with us in planning ahead and, the instability that we're facing. Because this is, we don't know what's coming next.
Yeah, so let me put my finger on the first part, and then we're going to talk about it, then we'll talk about inflation. So if you feel like a little bit of anxiousness, let's just put our finger on what that's about, and I call it the institutional framework in the United States. So what is that? What's made America so successful? Magnet for talent from around the world. Mm-hmm. Many brilliant people have come from around the world and gone to higher education here, stayed, become entrepreneurs, built businesses. That's true in Texas substantially. Yeah. And it's true around the country. Will we continue to maintain that flow of talent, magnet for talent? Will we maintain higher education has been a distinctive advantage for the U.S. That's part of the institutional framework. Obviously, rule of law, independent judiciary, independence of the Fed, the the way we deal between the federal government and the states and local governments in terms of, local situations. What's the role of federal troops? I don't even want to go there, but just all these matters. And obviously, we're seeing, some actions in our hemisphere recently. And then the tariffs. We have tended to be. We went for years where globalization probably went too far, where now the pendulum has swung to more deglobalization. I would guess it'll swing back, but we've benefited in the U.S. from integration globally with the world. Markets for our goods, markets for our farmers. I'm from Kansas, soybean farmers in Kansas being able to sell to China, our access to rare earths. The reason I think we're feeling some of this tension is we're in the last 15 months challenging some of those parts of this. I'm hopeful that this administration, I'll just say it, is one of the good things about them. They actively are talking to businesses. Previous administrations, ironically, may not have bothered people as much, but they didn't talk to businesses as much as this administration does across industries. And so they're hearing this feedback. And so I don't know what's going to happen, but I'm hopeful that we'll settle down, a framework and create more predictability for businesses. Now, in terms of inflation, let's just get right to the punchline there. Inflation in 2021 got as high as 9%. I would argue the big reason for it, it started as a supply chain issue, but it became an excess demand issue. Too much fiscal policy, I mentioned the $6 trillion of all those programs, and too much monetary. Fed was too accommodative for too long, bought bonds for too long. Fair enough. Okay, Fed finally reversed course. And with the new administration, Scott Bessent has made a big point. We don't want as much government-led spending. We want a more organically driven economy. But the tariffs have probably slowed the improvement in inflation we were going to see. So remember, the inflation issue up to 2025 was not a goods issue. Goods have been disinflating for the last 2 or 3 years. We've got enormous global manufacturing overcapacity driven by China. We've had disinflation. The inflation issue has been a services sector issue. The problem in 2025 is the goods disinflation is stopped because of the tariffs. It'll continue again, in my opinion, but it'll take a little while. And services sector inflation is still sticky. So inflation's running right now at 2.75%. Unemployment rates 4.5, 4.6. I think I'm hopeful what you'll see in 2026 is, as we get to the later half of the year, inflation will continue to improve. But if I'm at the Fed, I want to see it before I lower rates more. And I'll just mention, again, global manufacturing overcapacity driven by China is disinflationary. The tariff episode we're going through has interrupted that, but hasn't changed. We've got enormous overcapacity in goods in the world. Goods should continue over the years disinflating. And when we talk about AI, last comment, we're right now, whether we know it or not, we're just talking about the infrastructure part. Data centers, power, the AI build. We're in the first or second inning in AI adoption by industries. Okay, where all of us in our businesses are trying use cases. We don't know which use cases will work, but some of them will, some of them won't. But it's our estimate at Goldman Sachs that over the next 3 to 5 years, we could get as much as a 0.5 percentage point jump in productivity growth. It would be a big deal in GDP growth. So if we get that much productivity improvement, that should be disinflationary, all right? So I'm hopeful over the horizon, inflation will start to gravitate more down to 2%. I just don't know exactly when that will happen, particularly in 2026.
So really, the reality could be that it could be higher for longer.
It could be stickier because the tariffs and lack of workforce are making it stickier. However, I would argue the overwhelming structural drivers over the years should actually be, some of them should be disinflationary. But I think if I'm at the Fed, I think the administration would like the Fed to anticipate that disinflation and cut now. If I'm at the Fed, My mandate is not higher GDP growth, it's full employment price stability. I want to see the inflation improvement before I cut more. And I think the Fed funds rate right now is at neutral. What do I mean neutral? It's neither accommodative or restrictive. The real Fed funds rate, for those who want to know, is probably 0.75 to 1% would be our estimate, my estimate. 0 in Japan, probably 0.75% in Canada, about 0.75 to 1% real. But then you got to add the inflation rate. And whether you like it or not, inflation's running at 2 3/4. That means the neutral Fed funds rate is 2 3/4 plus 75 to 100 basis points. That's 3.5, 3 3/4. For those who think that neutral is 3, what they're basically saying is inflation is going to get to 2. And so therefore we should cut now because it's going to get to 2. But it hasn't been at 2 for 4 or 5 years. So that's the tension.
Okay, well, let me talk a little bit about inflation, because, we got a workforce, that this country was built on immigrants, and we've got to have those people come in, and the people that we bring in do great work. In construction, we couldn't do it without, immigrants from Mexico, and they're great at their work. And let's talk about that a little bit in regard to the laws and what might be changing or what could happen in the future, because construction is slowing down, and I'd like your comments on that.
So I don't have anything brilliant to say on this other than I think, again, during the first 4 years of the first Trump administration, workforce growth in the United States was 1 million to 2 million a year, and we had pretty healthy immigration growth. Workforce growth in 2025, we'll look back in hindsight, I don't know, might have been, I don't know what it is, 250,000, 500,000. Estimates for 2026, less than 1 million again. So I don't have anything terribly brilliant to say on why this is going to get better. I don't see any evidence that it
No
will.
change in policy politically?
I don't see any evidence yet that there's a change, but I do think the impact of it is clear. Lower workforce availability, harder to find people to do many jobs in construction, agriculture, services, and lots of open jobs. The problem is the people looking, many college graduates don't want those jobs, and we've got these mismatches. I think it would be healthier if we had better workforce growth. But do I think that's going to change in 26? Honestly, I don't see any evidence of it.
Okay. I think everybody here in this room might be interested in your opinion on the government shutdown and what happened, a month ago, and now we're faced the same, with the shutdown at the end of this month.
Yeah.
And talk about it?
I'll give you a 30-second piece of advice. There isn't going to be another shutdown. It's not politically popular. I think if the Democrats had a do-over, they might not have pushed to have that shutdown. It didn't work out well. I don't know how they're going to resolve the next impasse. I really don't. I plan not to watch television or read the paper too carefully while it's going on. I would encourage you to do the same, because there is not going to be another shutdown.
Okay. All right. Okay, that's it?
That's my view.
Yeah. Okay, well, that was worth coming here today.
If that's what's keeping you at night, you go back to sleep.
Okay, let's move into tax policy.
Yeah.
There's a lot of benefits that are going to happen.
Yes.
In moving toward real estate this year.
Yes.
And
it'll be very stimulative.
yeah.
And we think the tax bill alone is going to add varying estimates somewhere between 0.75% to 1% to GDP growth in 2026, period.
Okay.
It's positive. Now, there may be a hangover in the out years, but if you're thinking about building a productive asset, and I've talked to lots of companies, they're going to get it into the period and take advantage of this accelerated depreciation. It's having a powerful effect, and the tax on tips, tax on overtime, the tax refund that relates to 2025 where workers have been over withheld, because the tax bill on that was affected last year, but the withholding didn't change. You're going to get good tax stimulus, and there'll be more money in people's pockets.
Okay, I think getting toward the last question, I want to talk about the economy in Texas.
Yes.
And I always said, and I always felt, been in business a long time, that if the United States gets pneumonia, we get a cold. And we've always been affected.
Yeah.
But, it depends on how bad.
Yes.
And some situations have really been bad, 86, 90, where there was some issues.
Of course.
And it brought everybody here to most companies that were borrowing money became illiquid.
Yeah.
And so what's your thoughts on the Texas economy and like your comments?
I would guess for the foreseeable future, Texas is going to, on things being equal, is going to outperform the rest of the country. Why? Because I don't see anything changing from the primary driver, magnet for people and firms to come to this, very welcoming. This is Dallas, it's Houston, it's obviously Austin to some extent. San Antonio hasn't participated much, but I think it could participate more. But the state is a magnet for fantastic people from around the country who want to come here. I don't see that changing, and it's a virtuous cycle. The more people come here, the more people who are not here think they ought to be looking and thinking about coming here, and I don't see that changing.
Okay.
I don't see any evidence. Now, what could change it? If we don't invest enough in our schools, if we don't build enough infrastructure, we have to handle our water availability properly. Obviously, there's a number of social issues, property taxes, et cetera, but assuming, we handle these things right, this is a pro-business state with a pro-business, I've found, all the way from the governor down, this is pro-business government officials who are practical, welcoming, and want to encourage businesses to come here. I mean, I think that's just an enormous advantage.
Very good. And this is close to your heart. I mean, we're going to see a new Fed chair, in May. And is that going to, what do you see the policy? Is it going to be a change in policy? So,
there's been a lot of scuttlebutt about with a new Fed. So let's just, without going into the gory details, there's the Lisa Cook situation, and she's still in the job. With a new Fed chair, and I think Jay Powell will likely step down, he won't stay. There'll be control 4 of the 7 governors. The thing that, probably the most unreported story of the last month, which I was surprised nobody talked about it, the Board of Governors of the Fed unanimously voted in December to extend the terms of all the Fed presidents by 5 years, okay? Unanimous, okay? So that tells me, for those who were worried that there was going to be a move to change Fed presidents, I think it's less likely. So what does that mean?
Oh, I see.
That's a big deal to me. I was pleasantly surprised, but it tells me the new Fed chair is not going to come in with 7 votes wired. The new Fed chair is going to the extent that he or she wants lower rates or other actions, they're going to have to persuade other members of the committee in order to get to 7 or more votes. And so I think the new Fed chair is going to be arguing that we should anticipate inflation is going to ultimately get to 2, and let's cut now to get ahead of that. I think most people around the table at the Fed are going to say, if we don't see improvement in inflation that's visible, we've already cut 175 basis points, I want to wait to see it. That will be the tension and that will be the debate, but they'll have that debate. The other thing you may see the Fed do is relook at the Fed balance sheet, which is now 6 and a fraction trillion. For example, will they think about extending maturities or lengthening maturities of Fed holdings, which would help bolster the long end of the Treasury curve? Could they debate those kinds of things? Yeah, I could see them doing that too with the new Fed chair.
Any comments on the Fed's independence?
I think with what I just described, again, with the approval of all the Fed presidents, That doesn't mean you won't be cajoled and pressure and all that, but I think by and large the culture of the Fed, as we sit here right now, is we'll debate, we'll fight it out, but each of us will make the best decision we can based on what we believe. I still think I'm very hopeful that culture with the new Fed chair will continue. And I think it'll be important for the new Fed chair to show that they actually believe in that culture. Doesn't mean they won't argue for whatever they believe in, but they've got to persuade others as opposed to say, we have the votes and I don't really care what others think around the table. I think that's less likely based on what I'm seeing.
Okay.
Doesn't mean it won't happen, but I think it's less likely.
Okay. Okay, well, I think that that concludes, some of the questions that, I wanted to pose to Rob, and, hopefully, the conversation's been meaningful to you and your businesses. And 26 and 27, I'd like to open the floor, turn the lights up maybe, and see if we can, right here at 9:30. And we'll spend 15, 20 minutes, with questions from the floor. Anybody there? I can't see where there's, anybody got their hand up there? Just speak out. Yeah, go ahead.
Right. Thanks for being here. I guess just a quick question. Interest rates obviously impact our industry a lot. You touched on this with, short-term rates coming down, the 10-year being real sticky, kind of in that 4 to 4.25 range. Just curious if you could expand on what you're watching that may impact that and what your view is over the next 12 or 24 months, and do you see that 10-year coming down anymore?
Okay, so the front end of the curve, obviously, we've talked about is going to be driven heavily still by the Fed and what's going on with the labor market, what's going on with inflation. If GDP growth really is 2.5% plus, I would think the labor market may not be perfect and you may have these mismatches, but I think, again, I don't expect unemployment to go like this, why GDP growth is going like this. And then the question is what happens with inflation. So let's assume we get some relief, which most firms, including Goldman Sachs, believe you're going to get some improvement in inflation. You could see the front end come down more during 2026. So then what's going to happen? Then what drives the back end? The back end is market driven, supply demand. We got 39 on our way to 40 trillion of treasuries to sell. Around the world, it's been a struggle at this rate to get substantial demand to buy the long end, at least enough to get it to rally. And so what could help? I think if confidence in the institutional framework, not worrying much about tail risk in the US, that might get people to buy more duration. As the short end goes down, there's going to be money moving. We think there's as much as $7 trillion in money market funds in the front end of the Treasury curve. Some chunk of it's going to need to find a place to go. Maybe some of that will go to the long end. But the big issue that could also happen, if growth is as strong in 2026 is what I'm saying, and nominal growth therefore is going to be, 4.5%, 5%, real GDP growth in excess of 2.5%. If we control government spending, and we're going to find out as the year goes on how much we're controlling it, you may actually see the deficit go down. It finished 2025, I think, 1.8 trillion. If you get that much growth, it wouldn't shock me to see some improvement in the deficit. We're going to have to see whether that materializes. But if you get that much nominal income growth and some control of spending, maybe that improvement in the deficit will encourage bond buyers to say, you know what? Maybe we've got our fiscal house. We're going to get our fiscal house in order. Maybe I should be more willing to buy duration. So those are the kinds of issues. Now, I think Scott Besson is also hopeful that things like stablecoin, the so-called dollarization of obligations around, will generate more demand for the front end of the Treasury curve, which will free up the capacity for the long end. Regulatory relief may free up bank capacity if they decide to buy more treasuries. Those are the kinds of things that it's going to be supply, demand, and the deficit. I'll be watching carefully to see whether it's going like this or this.
Okay, any other, question out here?
Herbert and Rob, thanks so much for having this conversation today. You touched a little bit on AI, and I was just wondering, how do you see AI influencing decision-making in real estate, especially in areas like site selection, underwriting, and market research?
Yeah, so the tricky part right now is every company, and I mean every company I talk with, is got 7 or 8 or 9 use cases they're testing out. We'll know over the next 3 years. What goes with that is then you ask them, well, do you think your head count's going to go up? It's going to go like this? And every answer tends to congregate around workforce growth. We're not getting higher workforce growth in our company. I'm not sure workforce is going to go down, but I think what the base case is, employment will be stable, but we're going to have X% higher revenues to generate, and we're not going to need as many people. So obviously this will have a ripple effect and impact on employment, types of jobs, and office space. The other thing that's going to happen, we may go through a very uncomfortable next few years where you got folks who've lost their jobs because of AI, who need to either get retrained or repotted to get to another productive job. And I would say in the United States, history, we're not very good at getting people repotted from one job to another. And this is why Dallas Community College is so critical. The Greater Houston Partnership is working on this. Local institutions have got to get better at helping people get retrained and get into new successful jobs. And there's lots of middle-class jobs that pay $125, $150 grand a year plus that are open that I think a lot of junior colleges, workforce boards are talking about. We've got to create more awareness because there are going to be a lot of people who get disrupted by this and are going to need to get repotted. And I think it's going to be critical to the economy because it's in our interest to get those folks repotted to another productive job. We just got to get better at it.
Okay.
Question right here.
Mr. Weitzman, thank you for your hospitality today.
Thank you.
Congratulations to you and the entire team on all your success.
Thank you.
Mr. Kaplan, thank you for being here. Your perspective is unique, to say the least. You've had some great comments on AI, and you just made mention of stable coins. We obviously have a lot of disruption pending with AI, but I also think there's another potential disruption in the form of stable coins, crypto, tokenization broadly, but I'm also really interested to hear your perspective on its impact on the banking system.
Yeah.
What do you think is driving it? What's the path to adoption? And more specifically, if we do go to a stablecoin-based economy,
right,
how does that impact banks' abilities to lend money to consumers?
So let's talk about, if you put this all under the heading of crypto or whatever, alternative currencies, let's separate digital currency like stablecoin that is directly backed by a currency. You with me? In other words, you don't buy stablecoin for protection from a weaker dollar. You buy it, for other reasons. Or maybe you're overseas and you want to dollarize your exposure, okay? And so we think there's going to be great growth globally in stablecoins. The trick is, the trick on that one is, I know we've got to be very careful how we write the bank regulation to make sure that growth in stablecoin doesn't siphon off bank deposits. Right. And I think that's something that they've got to be very careful about in DC as they write the regulation. Okay, tokenization, without going into the gory details here, every bank we are studying it intensively because it's going to affect lots of collateral, the way collateral is done, frictions that we've just gotten used to when you need to borrow and you need to place collateral. Tokenization can alleviate a lot of those frictions. We've got some work to do, and the industry does, but yes, you'll see some big changes in the way collateral is used. It'll be easier. It'll take away some of the frictions. Okay, then you got one other thing over here. Then you get crypto. That is Bitcoin, others that are not tied to an underlying currency, has been a store of value, maybe an alternative to gold, is not widely used for transacting. And I don't know if that's going to change, and if that did change, I would expect the regulators are going to swoop in and get a lot more all over Bitcoin. But I think you're going to see enormous developments in both, but it affects the banking sector. Stablecoin and tokenization are certainly going to have an effect, and I hope they're done in a way that don't diminish the ability, particularly for small, mid-sized banks, to continue to collect deposits.
What's the timeline on that? Is it multi-year? Is it decades?
Well, so I can tell you we're studying it now. We don't have a choice. And so the short answer is I'm not sure I know. I'm not sure anybody knows, but I would say you'll see significant developments in the next few years. And the only comment I would make, and this is true of AI, things that we've been talking about, the speed of innovation is going north, up. So I would guess this is all going to develop faster. The trick is the regulation's got to catch up. Because you want to make sure you have guardrails that safeguard, important institutions here that we depend on for lending and other activities. But I would guess in the next couple, 3 years. But it's already developing.
Okay, one last question. Is there one last question here? Where is it?
Right here.
Okay, and then we'll wind up. Uh-huh.
A little bit more of a local question for you both, but
Sure.
More Dallas focused. There's a couple big relocation stories happening right now in the city. We have AT&T, obviously, which has announced that it's moving to Plano. But it also seems that the Mavs and the Stars are both heading towards departing the AAC. I'd love to get both of your perspectives on those two things, how the AT&T move will reshape downtown for better or for worse, and also if sometime in the next 5 years, if the AAC in Victory Park sits empty, how that could impact Victory Park. Rob, I know Goldman Sachs' new Dallas office is right around the corner.
Why don't you start and I'll...
Well, I think that downtown Dallas has problems, big problems. It's diversified ownership, and you weren't here when they did the Ponte Traverse plan and underground on the west side of town. There's all kind of passageways that buildings connect underground. And then the east side of town, they put bridges. It was not connected, so it never did work. We were involved in One Main Place in the leasing of that when that was built. That was supposed to be the new Rockefeller Center, and we had that had a very open park and events out there in downtown, and it didn't happen. The Overton family sponsored that. And today, we're going to see a long-term plan, with the convention center, billions spent on that, and then hotels, and and restaurants that'll be a byproduct of that, and also the potential of the Bank of America main tower building being redeveloped with on the west end. It's just it's not a master plan, because there's too many different ownerships, and it's going to be long term. And there's a dividing line, basically Ross Avenue, and south of that's downtown, and the north of that's uptown. Uptown is where everybody is coming and wanting to be. It's got it's very safe downtown. Even though I don't go down there often, but I understand that there have been major headway with the homeless, and it's gotten much better. No woman wants to go down and shop, with someone coming up and accosting them. That's just not. Somebody doesn't want to walk on the street after they come out of a restaurant and find somebody sleeping on the sidewalk, and we've got to get our arms around that. We've had this. we have this problem with homeless in our centers around the city. And I think that's the biggest issue. We're learning from a plan that Houston's put in effect, and it's made progress. I think we'll get behind that and we'll fix that. But the downtown restoration is with potential. The Discovery Center, it might be going or just going away from the standpoint of any occupancy by AT&T. But there's downtown. Dallas is a city that attracts people and investors from all over the world, and there are people that have put money in and continue to come to Dallas and put money in, and in the downtown area. I think the city's got to come up with a better plan. I think they will, but I think it's going to take time. Rob, it's all yours.
No, it makes sense. Listen, it's critical to this city and any big city in the United States that you ultimately have a vibrant downtown. That's why you see in a number of cities around the country, there's revitalization after many years. That's important. And then you need gathering places and community. That's the one thing the sports teams provide, some of the park developments that are going on, the Harold Simmons Park, other developments. We need those in this city. And this is why also our institutions, the symphony, other cultural institutions are very critical, but it's all part of the mosaic that makes this a more attractive place to live. So I do hope the plan that Herb talks about, the city really gets its arms around that.
Rob, where the Arts District is, you know what that was? That was warehouses.
Right. No, it's a great development.
That whole area it is nothing like it was.
Yeah.
Nothing. And
Great.
I think that if Dallas gets behind it and offers incentives, on remodeling and redevelopment of projects, which they did, we'll fix downtown. I've got every confidence in the world that, we will do that. There's the leadership here in the city.
Agreed.
It's got to be focused on. There's a lot of issues, that Dallas has. Look at Clyde Warren Park. I mean, what a phenomenal asset that is to the city today, and how many people enjoy that. And more people are coming in with contributions to put in, different water fountains and more things for the kids and so forth. So it's wonderful. And I think downtown Dallas, over the long term, is definitely going to be redeveloped.
And then any take on Victory Park or potential future there?
Victory Park, we were very active in Victory Park. I actually was a partner in Victory Tavern, which is a restaurant that was right there in front of the American auditorium gym. Or that project there is wonderful. Ross Perot had a great vision. The thing about it is, in retail, you can't go put and develop a successful traffic if you don't build out both sides of the street. He built out one side, and he put and we made some leases for him, and and I was in the Victory Tavern project, 10 years lease. There never was a distribution. No money was made out of the restaurant, and so too many people had to drive by wonderful restaurants to get to Victory. And I made a suggestion to Ross Jr., had lunch with him over there one day, and I said, you've got to make this a district. Like Post Oak District in Houston, you've got the Spandrels, Sterling Silver. You were there, but now it's slowly getting developed out, and both sides are retail, and I think that over time it'll be real strong. But it's got to go by so many. You got to go by so many great restaurants in Uptown, and more are coming. So in Uptown, to get to Victory Tavern, but it's densified, and that's good. Well, I want to thank everybody here. Rob, thank you so much.
Thank you. Great to be with you. Thanks, sir.
Thank you very much. Great.